things that the Fed and the Treasury did in 2020 were absolutely essential. If they hadn't done them, I think we would have had a global depression beyond anything that anybody alive today has ever seen. Now, the things they did are likely to have negative ramifications, starting with inflation. The mere fact that there can be negative ramifications doesn't mean they shouldn't have done it. It's a good thing they did it. But the ramifications are there, starting with inflation. And, you know, inflation is a little bit mysterious. Nothing in investing is mechanical. You know, you walk into a room, you turn on the lights, and they go on every time. The relationships are dependable. You put the switch off, they go off. Doesn't work that way in economics or in investing. And nobody is exactly sure why we get inflation. They say, well, it's ABC. But sometimes ABC happens and we don't get inflation. Sometimes we do. So it's imperfect. And, you know, if you look at the last decade, you know, after the global financial crisis, 2009 to 2019, we had very low interest rates. We had growing deficits on the federal budget and no inflation. These were supposed to be inflationary conditions, and yet it didn't happen. Now we have these things, and now we have inflation. So I just go through this so that your listeners understand that these things are imperfect and uncertain. Okay, so now what is the outlook for inflation? First of all, the Fed and the Treasury injected several trillions of dollars into the economy. And, you know, we have a GDP of about, well, in the 20th trillions, and they invested in the last, injected in the last year and a half, I would say, 10 trillion. So that's a big injection. And when you put more money into the economy, that is generally expected to be inflationary, because it gives people more money to spend. They bid for the things they want to buy. The auction goes high. That's called inflation. And that's a good part of why we're having inflation now. But that you would think would taper off. It would be limited in time because it was an injection of, you know, but hopefully they're not going to do it every year. And as we get further away from the injection, it should be less influential. But the point is that people received, in the US, people received government benefits. Unemployment insurance was extended. Even people who didn't lose their jobs received checks in the mail, up to, I would say, up to 80% of the population received checks in the mail. And by the way, you couldn't spend that check. You couldn't go on a vacation, or you couldn't go to have a wedding, or you didn't need to buy a dress for a wedding, and you couldn't go to a restaurant, you couldn't go to a show, and so forth. So, so people, that money piled up in the bank. When the vaccines came and it was possible to go out of the house and do these things, that money came flooding out. It was what we call pent-up demand. So that was a very strong and inflationary factor. The other factor is supply chain, you know, and I looked it up, by the way. This is interesting. How many parts are there in a car? I think the answer is 30,000 parts. Could be 3,000. It's some, but it's many thousand parts in a car. And if you don't get one, if one part is unavailable, they can't produce that car. They can't finish it. So because it was difficult to restart the economy after it being closed for roughly 9 months, just think about when you restart a car that hasn't run for a couple of years. It's very hard. So restarting the economy was problematic. Some parts were unavailable. It's what we call supply chain constraints, and so the economy cannot produce as many goods in a month as it did 2 years ago. So you have more demand because people have money in the bank that they're dying to spend, less supply because a lot of goods can't be completed. This is inflation. Most of these factors will taper off in the coming years. The government is not going to continue giving out money at that rate. I believe that the supply chain interruptions will be fixed, and the machine of the economy will start to run smoothly again, like it did 2 years ago. I mean, if you think about it, think back to 2 years ago, before the pandemic, very little is fundamentally changed about your economy, our economy, the world economy from 2 years ago. And yet it performs very differently because of this long layoff. So I think that, so those factors argue for most of the inflation proving to be transitory. That is, it goes away. There are factors that have a long-term implication, which is that for a variety of reasons, I'm putting out a memo today, by the way, and it lists some of the reasons why there are fewer people working today. Because there are fewer people working, if you need to hire somebody and you interview 3 people, those people can demand higher pay. Because when the economy is tight, when the labor situation is tight, employees have more bargaining power. So wages are going up, and you see that employers who have job openings are offering higher pay and bonuses and so forth. So this is inflationary. And once those higher levels of pay are achieved by the workers, they're probably never going to go back down. They may stop going, the rise may stop or slow, but they're not going to go back down. So that's fairly permanent. And the other thing is, inflationary expectations are very strong. If I tell you that we're going to have 20% inflation next year, well, you may have it in Brazil, but in the States, if we tell people that we're going to have 20% inflation, what do? They run out and buy everything and put it in their basement so that they can buy it before the price goes up. So that's inflationary behavior. And once the expectation of inflation gets built into the system, once people absorb it and retain it, that can be, number one, self-fulfilling. The expectation itself makes prices go up because you ran out to buy things. And number two, it can be semi-permanent. So these are the factors that argue that inflation will be long-running. I think we'll continue to have inflation above what it was prior to 2 years ago, which is less than 2, but not at today's level, which is more than 6. So I think we'll settle out somewhere in between. But you should know, number one, I'm not an economist. Number two, I'm very proud of that fact, as you know. Number three, nobody knows. So my guess is not worth much more than anybody else's guess.